Investment risk, a crash course for absolute beginners. Keep in mind that investment risk is not only limited to market risk, the kind that most people are generally concerned with. Market risk is the possibility that you might not get back the amount you originally invested due to a dramatic decline in stock and bond prices. Besides market risk, you have liquidity risk, concentration risk, credit risk, as well as reinvestment risk and inflation risk. Other exposures relate to longevity and investment horizon. Let's dig further. Welcome back, folks, to another edition of Sweetie Kiwi. How you doing today? I hope you are doing fantastic. I'm doing marvelous, if you were to ask me. And today I want to bring you into the wonderful world of investment risk, and I'm giving you a crash course for absolute rookies. If you are doing as fantastic as I am, go grab a cup of coffee or tea or vodka and let's roll. Let's first define the different types of investments. When you invest, you are exposed to different types of risk, right? Learn how different risks can affect your investment returns. We first talk about market risk. The risk of investments declining in value because of economic developments or other events that affect the entire market. The main types of market risk are equity risk, interest rate risk, and currency risk. Let's kind of go into the nitty-gritty here. Equity risk applies to an investment in shares. That's equity. That's stocks. The market price of shares varies all the time depending on demand and supply. Equity risk is the risk of loss because of a drop in the market price of shares. We have interest rate risk. This applies to debt investments such as bonds. It is the risk of losing money because of a change in the interest rate. For example, if interest rate goes up, the market value of bonds will drop. This is the inverse relationship between bond prices and interest rates. Currency risk. This applies when you own foreign investments. It is the risk of losing money because of a movement in the exchange rates. I'll give you an example. If the United States dollar becomes less valuable relative to the Canadian dollar or the European euro, for instance, the EU zone euro, your US stock will be worth less in Canadian dollars. That was for the market risk. So you have the trifecta: equity, interest rate, and currency for the market risk. Then you have now liquidity. Liquidity risk is the risk of being unable to sell your investment at a fair price and get your money out when you want to. To sell the investment, you may need to accept a lower price. In some cases, such as exempt market investments, it may not be possible at all to sell the investment. You also have concentration risk. This is the risk of loss because your money is concentrated in one investment or type of investment. So when you diversify your investments, you spread the risk over different types of investments, industries, and geographic locations. The bottom line here is that if you want to avoid concentration risk, you should not put all your eggs in the same basket. You need to diversify. Credit risk, what is it? This is the risk that the government entity or company that issued the bond will run into financial difficulties and will not be able to pay the interest or repay the principal at maturity. So credit risk applies to debt investments such as bonds. You can evaluate credit risk by looking at the credit rating of the bond, and those are usually issued by several credit rating agencies. The most important ones are S&P, so Standard & Poor's, and Fitch. So you have Moody's. There are three of them actually. You have Moody's, you have Standard & Poor's, and Fitch. For example, long-term Canadian government bonds have a credit rating of AAA, which indicates the lowest possible credit risk. In the last few years, we've seen companies file for bankruptcy, or companies we've seen them downgraded by rating agencies, even countries. If you think about it, when we had the crisis, the 2008 crisis, and what happened in Europe, for instance. I want to talk to you now about reinvestment risk. This is the risk of loss from reinvesting principal or income at a lower interest rates. Suppose you buy a bond paying 5%. Reinvestment risk will affect you if interest rates for example, dropped and you have to reinvest the regular interest payments at 4%. Reinvestment risk will also apply if the bond matures and you have to reinvest the principal at less than 5%. Reinvestment risk will not apply at all if you intend to spend the regular interest payments or the principal at maturity. Inflation risk. We hear about inflation all the time. People are talking about, we are in a hyperinflation or lower inflation environment. What does that mean? Inflation risk is the risk of a loss in your purchasing power because the value of your investments does not keep up with inflation. Inflation typically erodes the purchasing power of money over time. The same amount of money will buy fewer goods and services. So that's when they said if you were making $1,000, if you take $1,000 20 years ago, it will not be worth the same amount today. You will not be able to pay the same goods and services, pay for the same goods and services today with $1,000, unless $1,000 20 years ago is now equivalent to $1,300 or $1,400, then you'll be able to live comfortably. So inflation risk is particularly relevant if you own cash or debt investments like bonds. Equity shares that is, offer some protection against inflation because most companies can increase the prices they charge to their customers. Share prices should therefore rise in line with inflation. Real estate also offers some protection because landlords can increase rents over time, and we've seen this in some countries. It's even mandatory that you have a slight indexing, 1.5% or 0.5%, but the authorities have made it easy for landlords and other real estate investors to increase rents in a very methodical and strategic way. We also have something similar in the States where we have the COLA adjustment. So the cost of living adjustment, all of these things, all of these COLA adjustments are correlated to inflation. I want to talk to you now about horizon risk. Horizon risk. This is the risk that your investment horizon may be shortened because of an unforeseen event. For example, the loss of your job. This may force you to sell investments that you are expecting to hold for the long time. So if you must sell at a time where the markets are down, you may lose money. What about the longevity risk? This is the risk of outliving your savings. So this risk is particularly relevant for people who are retired and are nearing retirement. Foreign investment risk. That's the risk number 9 I want to cover with you today. This is the risk of loss when investing in foreign countries. When you buy foreign investments, for example, the shares of companies in emerging markets, you face risk that do not exist in the United States, in the UK, in Canada, in Australia, and some countries in Europe. So in those countries, in emerging markets, you might have the risk of nationalization. The risk of nationalization is also called foreign investment risk. Now, there are ways to counter that kind of risk. For example, going through the protocols and procedures put in place by the World Trade Organization, the WTO. You also have an international court of justice that allows companies to sort of mitigate the risk of nationalization. One thing I also want to mention here, and I want to go back to the longevity risk. Longevity risk is an important element in estate planning and wealth management, because the last thing you want is being 65 and you realize that you have no money, or you only have money that will last you for 3 more years, so that by the time you turn 68 you're broke. So there are mechanisms, there are strategies and tactics in place to allow an individual to counter that longevity risk. As a matter of fact, I love estate planners and wealth managers. They have this trifecta of 3L that I love a lot. 3 L's. So they have liquidity, longevity, and legacy. And longevity is the second thing. So you need to have liquidity to acquire, if you will, to drag longevity into your basket, if I can use that metaphor. And once you have longevity, then you can go to legacy. I'll be right back right after this. Don't go anywhere. Welcome back, folks, to another edition of Sweetie Kiwi. How you doing today? I hope you are doing fantastic. We are still here having a conversation around investment risk, and I'm giving you a crash course for absolute beginners on that kind of risk. All right. If you love the content clarity and quality so far, please consider subscribing to our channel and turn on the notification bell so you can be notified in real time whenever we drop a new show. And we drop this kind of shows every single day, rain or shine. Let's talk now about another type of risk. Keep in mind, all investments carry risk. As soon as you enter the world of financial markets, stock markets, bond markets, real estate markets, you're going to face risk. If you don't like risk, just stay home. Don't do anything. But life will be boring, right? So all investments involve some degree of risk, and in choosing between different assets, you'll be trading off risk for the potential or reward. So you have the duality, the risk-reward duality that you have to pay attention to. So the more risk you carry, the more risk you are exposed to, the higher the return, and vice versa. You must know the risk associated with any investments and ensure that it fits into your goals and circumstances. As a general rule, though, investments that have the highest potential return also carry the greatest level of risk. That's what I just said. Risk and rewards will go hand in hand. For example, concentrating on one stock or one market segment like technology is kind of risky, but it can also be extremely rewarding. In other words, with the chance of hitting a big also comes the potential of losing it all. There are three primary asset classes. We have stocks and stock mutual funds, bonds and bond mutual funds, and cash equivalents like money market mutual funds. Each carry its own level of risk. Let's just see here. We're showing you on the screen right now. You have the little column that we just prepared for you. So you have asset group. So you have a stock, bonds, and cash. So for cash, it's very low. The risk is low. Bonds, you have medium risk. And for stocks, you have higher risk. So stocks and stock mutual funds, as a rule, carry the most risk. Bonds and bond funds carry a moderate amount of risk, and cash equivalent carry the least. But please be careful of this oversimplification. My point here is that you have to keep in mind the duality I just told you earlier, to say that if you want to invest in stocks and stock mutual funds only, you are carrying a higher risk. However, if you have a properly diversified portfolio, chances are the risk may be spread. You can spread that risk over several assets and asset classes. So a stock index fund that is broadly diversified across different industries, for example, can carry less risk than a bond fund in a rising interest rate environment. For some of you who are rookies out there, as I said earlier, the interest rates and the bond value, the value of a bond, they are inversely related. So when one goes up, the other goes down, and vice versa. I also want to talk about the fact that, and this is something that a lot of people in the general public have a bit of confusion around, fear is different from risk. Fear and risk are not the same thing. So when I'm talking about risk here, I'm not talking about fear. Fear is a strong emotion caused by anxious concern over a real or perceived danger. Let me repeat that. Fear is a strong emotion caused by anxious concern over a real or perceived danger. In this case, the danger that brings on the fear is that the money invested will decline in value, even temporarily. So usually the fearful investor is the one who cannot sleep at night worrying about whether their principal amount is going to decline. The principal is the amount you invest. So if you invest $1,000 in bonds, if you bought bonds for $1,000, that's your principal. And then if the bond carries a 5% interest rate, you'll be receiving $50 every year in interest income. So fearful investors are often called risk averse, but in reality, they're just fearful. It's all about fear. They don't want to lose money. They don't want to see a decline in their principal, in their capital. To overcome the fear, they have to limit investments to bank certificate of deposits, so the CDs, treasury bills, and money market accounts. In truth, a fearful investor is still putting his or her retirement assets at risk. And the risk here is inflation risk. If you remember what I said earlier, what is inflation risk? Let's really, I just want to recap what I said about inflation risk. Inflation is the risk of a loss in your purchasing power because the value of your investments does not keep up with inflation. So if you have a fearful investor who puts his or her money in a CD, in other words, in a cash equivalent account, 10 years from now, that cash is not going to move. If it was 10,000, it would still be 10,000. But by then, what he or she could have bought with 10,000 today, could buy with 10,000 today, was not the same thing that he or she could have bought 10 years earlier. In other words, 10,000 today at constant dollar prices is less valuable than it was 10 years ago. So a fearful investor at the end loses money anyway. So this is the risk that your retirement funds will not earn enough to keep up with inflation and therefore have less buying power at retirement than they have today. The risk is most devastating over long periods of time. I took the example of 10 years. Years still okay, but 20 years and 30 years, can you imagine that? Imagine if you had $1,000 that was given to you 50 years ago, 50 years ago, and you left that cash in a bank account. And $1,000 50 years ago, you want to spend the same amount. You want to spend the same amount today, 50 or 60 years earlier, 50 years. What am I saying? 60 years later, that $1,000 is probably worth today $200 or $300. In other words, you can only buy stuff with that for $300 because prices would have increased in the meantime. So a loaf of bread that was probably worth 50 cents 60 years ago is probably worth today $2 or $3. I'll be right back right after this. Going around. Welcome back, folks, to another edition of Sweetie Key. We're also having a conversation today around investment risk, and I'm giving you a crash course for absolute beginners. Let's talk about risk changes with age and circumstances. And this is important. The perception of risk, the feeling around risk, the whole concept of risk mitigation and risk aversion or risk taking changes. This concept changes with age and circumstances. Investing always involves making decisions that balance risk and reward. I spoke about that, the duality. The decision you make today may not be appropriate for you later in life. When you're young, you can take risk. You can buy stocks. You can have 60 or 70% stock and 30% bonds. But as you age, you might want to switch that proportion, that mix around, that makes stock between stocks and bonds around. You need to factor in your age, years to retirement, and other circumstances in determining how much risk is suitable for you at any given time. When you are young and unmarried, you can take on more risk than when you are within 5 years of retiring and have others who are depending on you. As a 50-year-old, safety may appeal to you, but a low return on too large a portion of your retirement account is unlikely to provide any protection. And let me repeat that, any protection against erosion in purchasing power due to what? Inflation. So if you are within 5 years of retiring, for instance, you should not be taking on large amounts of risk. Instead, your concern should be with the safety of your principal. So understanding the balance between risk and return on your investments can help you build an investment strategy for your retirement assets that you can live and benefit from. You can live with those retirement assets and benefit from them. All right, folks, this was it for today's conversation. I want to quickly recap the conversation here. I spoke today about the different types of investment risks. So market risk, liquidity risk, concentration risk, credit risk, reinvestment risk, inflation risk, horizon risk, longevity risk, foreign investment risk, also called nationalization risk. And I also spoke to you about the fact that all investments carry risk. Fear and risk are not the same thing, and that risk changes with age and circumstances. I will see you next time. But until then, remember, stay marvelous.